Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Nvidia stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a really large cap company, 1.9 trillion market cap. They're trading at $7.85 a share, and they have 2.5 billion shares outstanding. Nvidia is the largest fabless semiconductor company. A bulk of their revenue is from sales of high performance chips for data centers. They also sell semiconductor chips to the gaming, mobile computing, and automotive markets. They are leading the way in artificial intelligence. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow grew a lot from 2021 to 2022. It went up 73% from 4.7 billion to 8 billion. But it dropped 50%. A lot of people don't realize this. But it went from 8 billion to 4 billion from their fiscal 2022 to fiscal 2023. They just completed their fiscal 2024. Their fiscal year ends 1/31. That's all the rage. Their free cash flow went up an eye-popping 600% to 27 billion. As equally as impressive are their margins. Look how much their margins have grown from 28% down to 14%, up to 44%. They convert nearly 44% of their revenue into free cash flow. A little less than half their revenue goes to free cash flow. They're an efficient beast. Net income is the profit or loss on the income statement. It's revenue minus expenses. That went up 125% from 21 to 2022, but down 55% into 2023 to 4.4 billion. It's shocking, right? That they were struggling. They were declining. It's just this past year, these past 4 quarters, they've been killing it. Their net income is 30 billion, a growth of 581% from the prior year. Same thing as before, equally as impressive, if not more impressive, are their margins. A 49% net profit margin. 49% is a good gross margin. Net profit margin is unreal. I did think they were overvalued for a while, but now that I see how profitable they are, I think they're valued at the right level, possibly undervalued. Revenue is the sales for the company, and that grew from 17 billion to 27 billion, then flat, also 27 billion in 2023. But it went up 126% to 61 billion. Alphabet has a similar market cap. Alphabet's revenue is over 300 billion. That's for the trailing 12 months. Meta's about 40% smaller market cap. Meta's revenue is 134 billion in the trailing 12 months. Amazon is a little smaller in terms of market cap, and their revenue is nearly 600 billion. So they do have a ways to go in terms of revenue, but they don't need to have 600 billion of revenue. You know what Amazon's net income is from 600 billion of revenue? It's 30 billion. They're both on the same level in terms of profitability. I know, it's crazy, right? That's why I'm saying this stock might actually be undervalued. I didn't realize that until I started doing more research the past 24 hours. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 1.5 trillion. We discounted those numbers back to today using weighted average cost of capital. We get a value of the company of $1.3 trillion. We divide that by 2.5 billion shares, and we get a calculated stock price of $5.14. They're trading at $7.85, so they're trading at a 53% premium. It's a sell according to the model. I know I said it might be undervalued, and now I'm saying it's a sell, but it's almost impossible to value a company like this. We really need to wait to see how their revenue grows over the next few quarters to value them appropriately. Of course, we can't wait a few quarters. We need to invest now or not invest now. I'm not investing. I'm just too scared and too frustrated that I waited this long. But if you invested in them, I don't think it's a bad investment at all. There are 62 companies in the same industry as Nvidia, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They are fabless, so they don't spend much in CapEx, only $1 billion. If you want to get into semiconductors, Taiwan Semiconductor is a good investment because they manufacture all the chips for Nvidia and Broadcom, AMD, lots of other companies. They're the largest foundry in the world. Intel is fabless and a foundry. That's why they spend so much in CapEx. But their semiconductor chips are inferior to Nvidia. They were the reason the PC boom took off in the 90s and the 2000s. But nobody buys those old computers anymore. They want AI. They want high-end quality, graphics, interaction. And the company leading the way is Nvidia. AMD is second, so they're a great company to invest in as well, at a much lower valuation. Nvidia doesn't have too much debt. Their debt-to-equity ratio is 0.3 for every dollar of equity. They have 30 cents of debt. Of the companies that pay a dividend, they pay the lowest dividend, the lowest yield. They generate more free cash flow than anybody on this list. In terms of market cap, if you exclude Taiwan Semiconductor, they're larger than the other 60 companies combined. A little larger. The other 60 companies combined are about 1.8 trillion. And they're larger than the next 6 companies combined. For a few decades, in the 90s and the 2000s, Intel was number 1 by far. Then from like 2019 to 2022, Taiwan Semiconductor was number 1. Now it's not even close. And their price multiples aren't so great, but they're not that bad. The reason I believe the stock is not going up as much as people think it is because they're moving with their price multiples, with their PE, their price of sales. Remember Tesla? They were at 1,000 times earnings because they weren't making any money. They were actually losing money. Same thing with Amazon in the early 2000s. They were losing money and people were buying the stock up. This company is making money, a lot of money, and their margins are amazing. They are trading at a lower earnings multiple than AMD and Intel. Broadcom is trading at 36 times earnings, so Broadcom is a better value. But in terms of overvaluation, AMD is much more overvalued than Nvidia. Just look at the PE and price to free cash flow. Maybe not price to sales. But who cares about sales? We want to make money, earnings, cash flow. Revenue is meaningless if you can't convert it to profit. And they're doing that. Granted, 72 times free cash flow, but it's not that much worse than Taiwan Semiconductor, and it's a lot better than AMD. It's also better than TI, and it's better than the average in the industry. Their revenue is $61 billion, second to TSM, and their 5-year annual revenue growth rate is 39%, even though they declined from 22 to 23, because they went up like 225% from 23 to 24. Let's go through their 10K. We'll start with their income statement, 2022, 2023, and 2024. So you can see their revenue is flat, almost identical from 22 to 23. That's why it's such a surprise how much they've grown. Because they may have had the best semiconductor chips, but they were really focused on the gaming market. AI wasn't that known until ChatGPT came out. I mean, AI has been around a long time, but it wasn't really talked about too much. I think that's why the gaming market was so big for them, because gaming needs advanced technology. We don't need advanced technology to speak to somebody on the phone or to use an app. But now we're seeing the amazing benefits of AI. You could just type a phrase in and it gives you a response like a human would. So let's get a breakdown of the 61 billion. More than double the prior year's number. 125% higher. Here's a breakdown by country. Of the 61 billion, a little less than half, maybe about 45%, is in the US, 27 billion. Taiwan, 13 billion. China, 10 billion. Now that's an interesting story because the US bans the exporting of high-end advanced semiconductor chips. So this company is pretty much cut off because they only make high-end advanced semiconductor chips. Revenue in the US more than tripled, but it didn't even double in China. So I think their revenue may actually go down in China unless they could get around that issue. It's mentioned right here. Our business activities are subject to various laws, rules, and regulations. During the third quarter of 2023, the U.S. government announced licensing requirements that impacts exports to China and Russia of our A100 and H100 integrated circuits, DGX, or any other systems or boards which incorporate A100 or H100 integrated circuits. That will greatly impact this company's sales in China. So if there's a Chinese semiconductor company you're familiar with, you may want to buy that stock because they're going to get all the sales in China. It's mentioned again right here in October 2023, the US government announced new and updated licensing requirements that became effective in our fourth quarter of 2024 for exports to China and country groups D1, D4, and D5. That includes Saudi Arabia, UAE, Vietnam, but excludes Israel, of their high-end products. They define it as products exceeding certain performance thresholds, including A100, A800, H100, H800, L4, L40, L40S, and RTX 4090. They are highly concentrated in data centers. That revenue grew 200% from 15 billion to 47 billion. Gaming grew very little. That used to be their bread and butter. That was their biggest revenue generator in 2022. Now it's well behind data centers. Professional visualization is flat from 2023, down from 2022. Automotive is barely up 900 million to 1.1 billion. OEM is down a lot to 300 million. Is being so concentrated in data centers an issue? Do you think that may be a problem? If you're not familiar with data centers, that's where all the computing happens. It's a physical location that stores the hardware. Without the data center, you don't have anything. It contains all the infrastructure, servers, data storage, network equipment. Another thing to think about is find companies that sell servers, drives, network equipment. Maybe those companies are undervalued and have a lot of upside potential, because as Nvidia grows, so will those other companies, because Nvidia has to buy products from them. Their cost of revenue is 16.6 billion. These are all the expenses directly tied to generating the revenue. Revenue minus cost of revenue gives you a gross profit, 44 billion of gross profit. Their gross margins are up 16 points from 57% to 73%. 73% is just amazing. Those margins, 73%, they convert 73 cents of every dollar to gross profit. 73% of their revenue is converted to gross profit. Above 50% is amazing. And look at their operating expenses. It's flat. Revenue grows 125%, and you don't even increase operating expenses. R&D is barely up, 7.3 billion to 8.7 billion. I don't see how that's possible, because R&D is how they come up with new products. Are they just so far ahead of the game they don't need to spend that much on R&D? It almost seems impossible, right? It almost seems like this is fake. I'm not implying anything shady is going on. It just seems too good to be true. Last year, R&D was 27% of revenue. Now it's only 14% of revenue. So their operating income went from 10 billion to 4 billion to 33 billion. That gives them an operating margin of about 55%. Net income of 30 billion, a 50% net profit margin. Their EPS went from $1.76 to $12. And their shares outstanding are down a little bit. It was almost 2.5 billion 2 years ago, a bit under 2.5 billion. Let's take a look at their balance sheet. Current assets of 44 billion, current liabilities of 10 billion, so their current ratio is above 4. 26 billion of cash and marketable securities, 10 billion of accounts receivables, that's up from 3.8 billion. Accounts receivables is how much money other companies owe them when they sell to those companies on credit. Inventory of 5 billion, that's pretty much flat from last year. They're in such high demand, they can't keep inventory. They're selling through a product. There's actually a backlog. There's more demand than they can supply. Here's a breakdown of their inventory, because manufacturing companies break down their inventory into 3 sections. Raw materials, 1.7 billion. This is the first part of the manufacturing process. The second part is work in process, 1.5 billion. And the last part is finished goods, 2 billion. Their total assets, 66 billion, up from 41 billion. They have 4.4 billion of goodwill. One of their bigger acquisitions was Mellanox. That's an Israeli supplier of computer networking products. They paid 54 billion from ARM, a UK company. That was in September 2020. That was actually a failed acquisition. I'm not sure why it's on this list, but I know they invest a lot in this company, ARM. ARM is up well over 100% in the past year. It did hit 150 recently, but it's come down to 128. They acquired Accelero in 2022. That was a small one, 35 million. They're a block storage provider. They were founded in 2014. Let's go back to the balance sheet. 6.1 billion of deferred income taxes. Because it's in the asset section, these are taxes that are due to Nvidia. They have 23 billion of liabilities, accrued and other liabilities, 6.7 billion. Here's a breakdown of the accrued liabilities. 2 billion of customer program accruals. Excess inventory purchase obligations, 1.7 billion. Deferred revenue, 760 million. Payroll related expenses, a very common type of accrued liability. Not much debt relative to the size of the company, only 8.5 billion of long-term debt. Here's a breakdown of their debt. 9.7 billion of total debt, 1.25 billion of short-term debt due within 12 months. That's right here. Look how low the interest rate is, 0.66%. They pay really, really low interest rates because there's such a low credit risk. Assets minus liabilities equals equity, 43 billion of equity. They raised 13 billion from selling their business. They profited 30 billion from running their business. Retained earnings is the sum of all their prior net incomes minus the sum of the dividends they paid out. Let's look at their statement of cash flows. The first section is operating cash flows. So much cash, 28 billion. A lot higher than last year at 5.6 billion. Operating cash flow is net income converted to cash. It's net income plus the non-cash items on the income statement. Stock-based compensation, 3.5 billion. Depreciation and amortization, 1.5 billion. Then we have to adjust for changes in working capital. It looks like they extended 6.2 billion of credit. That's a cash outflow. They added 1.5 billion of accounts payable. That's a cash inflow. In their investing section, a lot of purchases and sales of marketable securities. This is a good way to earn interest on some of your cash. 83 million of acquisitions, 985 million of investments in non-affiliated entities. So maybe this is stock they bought of other companies. In their financing section, they bought back 9.5 billion of their own stock. Last year was 10 billion. I wonder why they didn't buy back more this year. They repaid 1.25 billion of debt. You see cash at the beginning of the accounting period, 3389. The change in cash is 3.9 billion. Change in cash is operating cash flow plus investing plus financing. They started with 3.3 billion. They added 3.9 billion. They ended the period with 7.28 billion of cash. That equals the cash on their balance sheet. You see the balance sheet, 7.28 billion. They started the accounting period with 3.389 billion. They ended with 7.28 billion. This is the statement of cash flows again. The beginning 3.389 billion, the ending 7.28 billion. That's how you track the cash. Let's take a look at the stock on Simply Wall Street. Its last price $785, 1.7 trillion market cap, up 8% in the past week, up 232% in the past year. Let's see what they say about the company. Nvidia provides graphics and compute and networking solutions in the US, Taiwan, China, and internationally. The company's graphics segment offers GeForce GPUs for gaming and PCs. The GeForce Now game streaming service and related infrastructure, and solutions for gaming platforms. Quadro Nvidia RTX GPUs for enterprise workstation graphics, vGPU software for cloud-based visual and virtual computing, automotive platforms for infotainment systems, and Omniverse software for building 3D designs and virtual worlds. Its compute and networking segment provides data center platforms and systems for AI, HPC, and accelerated computing. Mellanox networking and interconnect solutions, automotive AI cockpit, autonomous driving development agreements, and autonomous vehicle solutions. Cryptocurrency mining processors, Jetson for robotics and other embedded platforms, and Nvidia AI enterprise and other software. The company's products are used in gaming, professional visualization, data center, and automotive markets. Nvidia sells its products to OEMs, original device manufacturers, system builders, add-in board manufacturers, retailers/distributors, independent software vendors, internet and cloud service providers, automotive manufacturers and tier 1 automotive suppliers, mapping companies, startups, and other ecosystem participants. They have a collaboration with Kroger, incorporated in 1993, headquartered in Santa Clara, California. One equity analyst has them priced at $478, another at $195. Look how much they increased in just 1 year. You could have got it for $143 at the end of 2022. Even if you got it in 2021 at over $300, you're still doing really well. And if you bought it before 2020, you could probably retire. Simply Wall Street's price is $529. They say the stock is 48% overvalued. 50 analysts priced this stock at $856. Their revenue target for 2025 is $110 billion, 2026 $129 billion, 2027 $150 billion. And their free cash flow target for 2025 is $50 billion, 2026 $59 billion, 2027 $78 billion. This is just phenomenal growth if they can hit it. They were debt-free in 2013. Their debt peaked at $12 billion in 2021. It's currently $10 billion. But their equity has gone up as fast as their stock price has gone up. Equity of $43 billion, much higher than their debt. And if you look at their cash, the green line, it's more than their debt at any single point. So it's almost like they're debt-free. They did have a dividend yield of 2% in 2014, but they don't raise their dividend. They kept it flat. So that's why the yield is 0.02%. The CEO's annual salary is a cool $1 million. He's been CEO for 31 years, total compensation $21 million. In the past year, only insider selling, no buying. About 700,000 shares have been sold by insiders in the past year. 68% of the companies held by institutions, 28% by the general public, and 4% by insiders. The biggest shareholder is Vanguard at 8%, BlackRock at 7%. The CEO owns 3.5%, which is $58 billion. I'm surprised he doesn't own more of the stock. You have lots of companies, JP Morgan, BNY Mellon, UBS, Eaton Vance, Alliance Bernstein, Bailey Gifford, Goldman. Employee count up a lot in 10 years, 8,800 to 26,000. And they trade in lots of places, the Nasdaq, Zitra, Deutsche Börse, Mexican Bolsa, Swiss, Borsa Italiana, Wiener Börse, the Lima Bolsa, Bulgaria, Kazakhstan, BATS Europe, Buenos Aires, Sao Paulo Bolsa, and the NEO. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.